So Neal Bawa, he is our welcome special guest. I am delighted to have him here. As I was telling him backstage, I am a bit of a groupie only because I admire his analytical, scientific mind and his approach to the way that he analyzes and invests. In his specialty is commercial real estate, multifamily. Ours is single family, but there's definitely a lot of similarities and differences that we can talk about, especially market dynamics. So, but Neal, some of my audience may not know who you are. I've been following you for a long time. I would love for you just to give a little tidbit about who you are, what you do, just some personal information. Give us a go. Tell us who you are.
I'm a technologist. I'm a recovering technologist, computer science degree. I had a successful tech career, ran a company from 1999 to 2013, sold it to a private equity firm. And while I was doing that, I had the big fat tech salary in Taxifornia and was paying 50% to the man. And so I got into real estate basically just to save taxes, and ended up buying more than a dozen properties in California. No investors, nobody else. It was just me, made my own mistakes. Did that for about 10 years. And then 2008, 2009, I got very interested in the data science of real estate. So opened a meetup in the San Francisco Bay Area. 4 people showed up the first time, 10 people the second time, and 100 people the third time we held it. And it sort of became a big meetup. I started getting a whole bunch of people around the US sort of inviting me to their conferences as the token geek that basically had nothing to sell in real estate, because I was a tech guy running a tech company. And so they loved that there was no pitch. And I loved it because I was getting free air tickets and free conference tickets. And I did that for about 4 or 5 years before we sold our company. When we sold our company, I had a gigantic tax bill. And basically, the only way to get rid of that tax bill is to stop buying single families and buy very large multifamily. So I bought my first very large multifamily in that year and sort of never looked back. We bought thousands of units. We built thousands of units. We currently have about 1,300 slightly geeky, nerdy investors. A lot of them are from Silicon Valley because I live in Silicon Valley. And, that's what we're doing. We do a huge amount of data and content that we publish on the web and appear on podcasts like this one.
Beautiful. That is a phenomenal summary. I appreciate that so much. And it doesn't surprise me that your initial meeting went from, I don't know, I think you said 2 to 4 to 100, and then you get these invitations. You guys, if that's any indication of the quality of content that comes from this scientist, data analysis, or I guess analyst and technologist, which he is all of that and more. So
well, I would say I'm an amateur data scientist. I'm trying to gather data. Anyone that basically treats data as a science is an amateur data scientist, and that's really what I am. My degree is not in data science; it's in computer science. But I really feel like data can help us make better decisions. It can also help us be more confident in our decision making. A lot of time people would do the right thing and then make a U-turn, and not wait long enough. And really, data helps you sort of be patient and wait, the length. I mean, right now where we are in 2026, and I obsessively study the single family market, even though I'm a multifamily guy, because the single family tells me what's going to happen in multifamily, right? And right now is a time of great patience. And that's what data is telling me. So we can talk about, why we need to be patient for 2026.
Well, let's jump right in there. That was a phenomenal segue into something that I was going to ask. So what do you see for, and I know you and Toby, and if you guys, I'm going to give you a little plug. What's Toby's podcast called?
It's a YouTube channel actually. So I don't know that, but Toby's a lawyer. He works for Anderson. So if you type in Anderson, Toby, YouTube, that's the first link that comes up.
You guys, trust me, you want to listen into, I tune in every year to Toby and Neal when they do their joint collaboration on the 2026 forecast. I think that's what you guys call it. Yep. It is always enlightening and enriching and content rich. So definitely tune into that. All right. So now let's get back into, since you are a scientist and you do focus on looking at the predictability of what's going to happen in the multifamily market by looking at what's happening in the single family market. I would love to hear some of the indicators that you're looking at, some of the metrics that you're tracking. What are you seeing for 2026?
Yeah, let me set the groundwork by saying this. This is not something that you hear very often, but multifamily is just a piece of the overall rental family. So the single family market is bigger. There's more single family rentals in the United States than there are multifamily rentals. Multifamily is about 20 million rentals currently, maybe a little more. Single family is higher than that. And so a lot of people are like multifamily and single family are different. They're not tied to each other. The answer is no, that's not true. Multifamily and single family are tied to each other. If in any market you have a large amount of Class A delivery, especially brand new, buildings, and they start offering 2 months of concessions, I guarantee it, 100% of the time, single family rents will go down. Now, they probably won't go down to the level of that Class A. They'll probably still be higher because people want to live in single families, right? I mean, I've never come across any tenant, especially ones with families, that wanted to live in apartments. People live there because they can't afford the single family rentals, right? So the
Right.
way the world works in rentals is it's Class C apartments, 40, 50 years old or older. Then you got the Class Bs, which are 20, 30 years older. And then you've got the ones that are less than 20 years old, all the way to being new. That's Class A apartments. And then above that is single family rentals, right? One step above the Class A's. And so what happens is if you have a very large amount of supply coming into the Class A market, of course it affects the B's and the C's, right? Because these guys are going to give 2 months off concessions. That's going to affect the rents of the B's. Those guys are going to offer a month of concessions, and that's going to affect the C's. But you should also know that it affects upscale, wind, because if there's enough of a gap that opens up between the Class A's and the single families because the Class A's are dropping their rents because there's a lot of supply, then the single family rents start to drop. So it's very important to understand that there is one rental market in the United States with single family sitting at the top of it. So to understand what is happening in the single family market, you need to look at multifamily. And to understand what's happening in multifamily market, you need to look at the single family market. So I'd like to sort of point out how different, dynamically, crazily different the single family and multifamily markets have been in the last 4 years. So until
Okay.
2022, right, when interest rates were super low until early 2022, they were both going up pretty much the same at crazy pace, right? So rents are going up crazy for single family and multifamily. Multifamily prices are going crazy. Single family prices are going crazy. So far, so good. Then in 2022, in the second half, we start raising interest rates. And as that happens, multifamily stops going up. So it flattens out for a while for all of 2022. And then it starts to go down. Why? Because most people that are buying a single family rental think that they are basically doing a business. Okay. And it's not true. I'll say maybe 1 in 10 people, 1 in 20 people are really doing a business. And I'll give you an argument for that. Most of the time, if you're on the coast, so Boston, New York, Los Angeles, right? Big markets with tens of millions of people and people buying investment properties all the time. None of those investment properties in those markets, those Class A markets, fancy markets, should ever be purchased, right? Because there's never any cash flow. When you buy a rental property in the San Francisco Bay Area, you have to put $5,000 into it every month, right? If you were buying a business like a Taco Bell, would you ever buy a Taco Bell where you have to pay the Taco Bell $5,000 a month? You wouldn't do that. You wouldn't do that to a Burger King, right? So the whole point of buying a business is that you purchase it and it starts to pay for itself immediately, right? In real estate. But today, a significant portion of all single family purchases that are investment purchases are negative cash flow. You see what I mean? Right?
Mm-hmm.
And so single family rentals and investment is more emotional than multifamily. And I'm going to prove it to you in the next minute. Okay?
Beautiful.
So in 2022, interest rates for single family were in the threes, 3.5%, something like that.
Mm-hmm.
As we're recording this in 2026, they're 6.5%. Last year they were 7, right? So this year they're 6. So it's fair to say that they've doubled, right? The mortgage has doubled,
Yep.
right? Fair to say that, or more, right? Here's the thing: because the mortgage has doubled, the average price of a multifamily or apartment property in the United States is down 25%, right? Today, the same property, same square footage, same age, is 25% cheaper than it was at peak in early 2022. So 4 years have passed and prices have dropped 25%, even though today rents are higher than they were at that peak. So in 4 years, multifamily rents have gone up. They haven't gone up in the last year, but over the 4 year time frame, they've gone up. But prices are down 25%. Why? Because anyone buying a multifamily simply calculates how much they can afford to pay for it to get to a certain cash flow, to get to a certain cash flow. So when they do
Right.
that math, if interest rates go up, they'll pay a little less. They go up again, they'll pay a little less. So over the 2 years that the Federal Reserve was raising interest rates, every time the Fed was raised rates, the price of multifamily would fall and fall and fall and fall. And you would think, well, the single family market, they're investors, they use spreadsheets, they're rational. The price should fall. It did not. 2022 was the peak of multifamily pricing. 2022 was not the peak of single family pricing in the US. Maybe individual markets might have dropped, but in
Yeah.
general, if you look at the market, today's price in 2026 is significantly higher than 2022,
Too.
which
Yeah.
makes no sense given we're paying double the mortgage. You see, right? Right? And the last 4 years have not been great for rent increases for single family or multifamily, right? So again, you might have an individual property at this market which has done great with rents or blah, blah, blah. I'm talking about 30 million rentals. I'm talking about 30 million rentals together. And I can tell you rents for those 30 million renters in the last 4 years are probably up like 5 or 6%. That's nothing. That's lower than inflation. On an inflation adjusted basis, the rents in the last 4 years were negative, right? Because inflation was very, very high. At one point, it was 9%, then 7,
9.
then 5, then right now it's around 3, right? So you should have at least seen that much rent increase. We didn't. So on an inflation adjusted basis, the last 4 years have not been good for rent, single family or multifamily. But you've never seen single family prices drop in any of those years. They didn't drop in 23 or 24 or 25 on a national basis, right? And that tells me that as a asset class, single family is not as logical as multifamily, because we should have seen single family prices drop by at least 10%. There are other reasons why single family prices shouldn't drop as much as multifamily, but the fact that they didn't drop at all tells me it's a deeply illogical market, right? And in some ways, that is helping multifamily, because if single family prices had dropped 10 or 15%, our prices, multifamily, would have dropped even more further.
Yeah.
So we were actually protected by the fact that the single family market was super robust.
Well, I think that wouldn't that lend itself to the supply issue? I mean, we've been vastly underbuilt. I mean, I know multifamily, you guys sort of caught up with, because it takes 2 or 3 years to get a multifamily to market, right?
Yep.
Through all the production.
Yep.
Well, it doesn't take that long for a single family, right? We can produce those a little bit faster. But if you look at, sort of looking at one of the reasons why did the single families pricing increase over that same time period, where multifamily decreased over that same 4-year period? Couldn't we say that it was related to the limited supply? There's pent up demand for sure. I think you and I know, we've been in this long enough to know that when interest rates drop organically below 6%,
maybe. So here's what I'll tell you, right? So there's a big difference between multifamily and single family, and I'll tell you why. When you look at multifamily and look at who's building multifamily, the vast majority of multifamily being built in the United States today is individual groups like Neal Bawa, right? I'm no big guy. There's 10,000 people like me that are building multifamily or building apartments or townhomes. But if you look at the single family market, you'll notice that the top 5 builders are huge companies. Lennar, right? What's it? The D.R. Horton. D.R. Horton is the largest,
Yep.
right? You got Lennar, you've got KB Homes, right? And
Yep.
so Pulte. So what has happened is that these top 5 companies are now building a very substantial portion of all single-family homes in the U.S. And these guys are rich enough. They're public companies. I'm not a public company. Most people building multifamily are not public. These are public companies that can borrow money cheaply from the stock market. And these people have done an incredible job in the last 3 years. Kudos to them, because what they've done is they did have a large amount of supply come into the market because they picked up, free money in 2022, just like, multifamily people did. So they had a lot of supply coming in. But you know what they did different is they had a huge amount of concessions because they had cheap debt. And they were able to basically say to people, right? Oh, you want to buy my property? I'll give you 5% as your rate for the next 3 years, right? And people are like, well, but interest rates are 7.5%. Yes, I'll pay the difference. So by doing that and manipulating the interest rates down to 5, for buyers, not for 30 years, but for 3 years, they were able to sell a massive amount of inventory and never let the price drop. The price remained the same, even though internally these companies gave up half or more of their profit in terms of the interest kickbacks that they were offering to the lenders. So this kickback stuff is not public. It's not information that anybody knows about. But if you go back and look at the profits of all of these companies, they dropped by more than 50%, right?
Okay,
But the
now this
market price didn't drop. And so everyone's like, oh, yay, there's still demand. Yeah, but it's artificially created demand where they're handing out $20,000 or $30,000 per sale in terms of interest rate kickbacks, which are not visible on Zillow or Trulia.
Okay, that's true. Now it's a nice segue into the strategy how we pivoted, because let's go back to 2022, right? Even leading up to 2022, I'm sure your business as well as ours, the multifamily and the single family, we were doing extremely well. Money was
Oh,
super
yeah.
cheap to borrow. It's like properties were just flying off the shelf. I couldn't keep anything in stock. I didn't have an inventory page to view properties because they were snatched up so quickly. Now, let's look at the last from 2022 to present day. And this is exactly the same strategy that we used with the home builders, but we're the small guy. We're not a publicly traded company. We're a private company. But we pivoted, and we had to, because in 2022, when the interest rates doubled, I have never seen that. I've been doing this 19 years. I have never seen the interest rates double like that. That accelerated that quickly in that short of a time. That happened, and it was like, oh my gosh, do we even have a business? So what we did, just like the builders did, we didn't mess with the price, but what we did, we decided that we would take less in profitability in exchange for buying down the interest rate in bulk, but not for 3 years, for 30. So we lock in investors at 5.5% for 30 years.
Amazing.
Right? And that has been, had we not done that, I don't know if we would still be a turnkey operator that survived, the real estate downturn in the last 4 years.
I think you did the right thing, right? So my point is this piece that we just talked about, it's not possible to do on the multifamily side. There's no business way to basically knock down the rate on the multifamily side. And that was one of the biggest differences on the two sides. Are we undersupplied in this country in terms of single family homes? Sure. But should the prices have dropped? Of course. The mortgage doubled. The mortgage doubled, right? So the price stayed up artificially high. So that was the first reason. The second reason, which is now ending, is this. Everyone who could refinanced in 2020 after COVID hit, or 2021 or early 2022. I'll give you my numbers. When I bought my home, I live in a big home, expensive home in Silicon Valley. I started with 8.25, then I went to 5.25. Then in 2009, I went to 3.25. And then in 2020, I went to a 15-year loan at 1.75, right? I'm not bragging. I'm just pointing out that 2020 was just a crazy time. And so now, even if I want to, I can't leave, because if I just sell my home to myself, right, return my mortgage and get a new mortgage, that mortgage is at 6.5%, my mortgage goes up $65,000 a year, right? So I am locked in, and 18 million American families are locked in because their interest rates are below 5%. They can't go anywhere. And that basically reduces the amount of inventory in the single family market. But that's not, once again, that's not a multifamily issue.
That's a single, that's that lock-in effect is really, it's really affects the single family market. And I don't really understand. I don't understand the multifamily market. I've invested in a few as a private placement. Like, here's my money. You have someone else do all the work.
Well, you just can't lock in, because the multifamily market doesn't allow for you to just refinance whenever you want. So one of the biggest benefits in single family is the law says that at any point in time, I wake up today and decide I need to refinance today, I can refinance, and the lender can't stop me, right? Well, there's no such thing as commercial. There are actual commercial loans where people have paid $5 million in fines just to refinance, right? So commercial loans, they have a certain duration, and if you basically pay them down early, you have to pay huge fines, prepayment penalties, which don't exist on the single family side. So in this instance, in this time, that hurt multifamily. It didn't hurt single family as much because of the lock-in effect. Now, I want to point out, we're doing this in early 2026. I measure the lock-in effect. And you measure the lock-in effect by simply looking at the percentage of homes in the United States with mortgages under 5%, right? That percentage was briefly up to very, very high level, never seen anything like it. It's dropping, and it's continuously dropping because, divorces happen, deaths happen, people have to move for their jobs. So even if they're locked in, they sometimes are just forced to move, right?
Yep.
And because of all of those, the lock-in effect is waning. By 2027, the lock-in effect goes away. And at that point, I'd be curious to see whether single family continues to maintain its price or if it starts to adjust. Now, it might be lucky, and by that time, maybe the mortgages are in the fives and the problem goes away. But mortgages right now are still in the sixes, and affordability is at an all-time low. Just so you know, this is the most unaffordable time in history for an American to buy a single family home, right? It's never been close.
And okay, so that's one of my questions that I had here was affordability and really the U.S. becoming a renter's nation. This was something that I picked up. Now, I didn't fact check it. I just listened to it on a podcast. So, but it was the average mortgage payment for a single family in the United States today is around $3,300.
Yep.
And you could get you could get a rental property. The average rent in the United States for a single family is around $1,800.
Yep.
So that is really pushing a lot of people into the renter's nation out of home ownership because it's just lack of affordability. Either they don't have the down payment, they don't have the credit, they don't have the know-how. There's a variety of reasons. Wages aren't growing as fast as that they need in their specific industry in order to be able to afford that higher monthly payment. So their only resolve is to rent and continue to rent. So that's, for us, that is a plus.
It's a huge plus. It's a massive plus, right? Because the U.S. somehow escaped for the last 6 or 7 decades the curse of other industrialized nations like Canada and all of Europe. Right? None of those nations had ever reached 50% home ownership rate. The United States is at 63 or 64%. So we were the unique nation amongst the rich nations of the world where 2/3 of our population lived in homes that they owned, right?
Yeah.
But the current rate of the current generations that are buying right now is at 40%. That's lower than Canada. That's lower than Europe, right? So we are turning into a renter nation, essentially roughly 20. So that gap that you mentioned, it's a 61% difference, right? So your numbers and mine are the same. So about 1,800 for rentals, about 3,300 for a mortgage payment if you're buying a property. It's about a 61% gap, right? So the bottom line is that those numbers are so absurd that about 20 to 25 million American families have completely lost the American dream. Have completely lost it. Their chances of catching up, maybe 1 in 100 will, maybe 1 in 200 will, but the gap is so massive, and it's never been this massive, right? We're talking somebody needing roughly a $37,000 salary raise to go from where they are today to where they can buy that home, right? $37,000. How many people receive $37,000 salaries? That's why I said it's a 1 in 100, 1 in 1,000, right? So you have to have an extraordinary increase to jump from where you are. So these 25 million families, unfortunately, the American dream has been destroyed for them. 25 million American families will never own a home. And the Americans' wealth comes from their homes.
100%.
Right? More than half of all the wealth that this country has ever generated comes from home equity. And we broke that. And what's interesting is people think it broke 10 years ago. It didn't. It didn't break 15 years ago. It didn't break 6 years ago. It broke after COVID. If you look at the map of that average monthly payment for mortgage and that average rent, the monthly payment was always a little bit higher than rents, but people want to own, right? So until 2020, the two lines were close with mortgages being a little higher than the monthly rent. Then after that, we saw this enormous difference, this gap open up, right? And so rents went up very slowly, 2 to 3% a year, right, to 1,800 today. But the home price, the mortgage, which was about 2,000, has gone from 2,000 to 3,300 in that time frame. And that massive gap has opened up, right? We broke the American dream right after COVID.
And I think there's a general sense of that. I mean, I was kind of tracking what the percent of home ownership was in the United States. The peak was in 2014 at 69%,
Yeah.
and since then to present
We're about
day,
63, 64 right now. Yeah,
yeah,
which is pretty good. The problem is, what about the new generation? They're nowhere
correct.
close to 64, right? I mean, for if they're pushing 40%, I'd be impressed.
And that's, I mean, and I have three kids, right? And they're all turning this year. They'll be 2019 and 16. And so, and I live in California too. So when I sell my business, I'm going to have to move out of California so I don't get socked with that extra tax on there. And don't even get me started. I'm sure you have. This is a side note, but did you see that the state of California is trying? They were trying to add on a 30% transfer tax when you sell a piece of property in California. On top of all the other taxes, they want to add a 30% transfer tax. That I think that's got shot down. And then now this is where it goes back. We're going to come full circle. We're going to come right back to where you started. And the reason that you started investing in real estate in the first place was to reduce your tax liability legally. Right. And that was the reason why I started. I think it's a lot of reasons why people that are tuning in because they hear about it, they don't necessarily know all the workings, inner workings of it, but they've heard and they have a general sense that if you invest in real estate, it can reduce your tax liability, and it does it in a variety of ways very successfully.
Well, right now is,
Um,
I mean, actually a great time because of something known as accelerated depreciation or bonus depreciation. So it's the investing in 2026, 7, 8, 9, and 30. So the next 5 years, bonus depreciation is available and stunning. I mean, people do bonus depreciations on duplexes, on triplexes, on fourplexes. I mean, it's stunning the amount of money that you save from bonus depreciation and the big beautiful bill. That was sort of the biggest gifts to real estate to bring
yeah,
bonus depreciation back. It's pretty impressive actually.
so you guys heard it here first. Listen to Neal. That for the next 5 years, you want to be investing in real estate. Take your hard earned capital, put it in a vehicle that's going to produce cash flow, generate monthly income, reduce your tax liability, have someone else pay your mortgage debt down for you, so that you can accumulate the wealth that you're looking for. I know we've been talking for a little bit. I'm curious to hear what your thoughts are, if any, on the the eventual switching of the guards, so to speak, at the Federal Reserve. How do you think that is going to have an effect on the real estate market for the rest of 2026?
So I think obviously there's a lot of headlines about this. My belief is it's not going to have the impact because luckily this is when like Trump hires somebody and puts them in charge of immigration. Well, that person is now making all of the decisions. That is not how the Federal Reserve works. The Fed is an independent body. Even if you put individual people on there that are basically just listening to you, the overall organization is not a government organization. The data that they're getting is private data. So that is, I think that we're going to get maybe an extra rate cut this year because of that. So I'll say yes. But if we think that we're going to get 4 rate cuts this year, no, I don't think that's going to happen. Because if we do that, there will be panic in the stock markets. The stock market will crash, which will force the Fed to back off, right? So it might
Yep.
happen. We might basically get a major cut in June because the new guy comes in like in May, right? So if you get
Nay.
like a 50 basis point cut in June, then after that you'll see conniptions in the stock market because of that, and then they'll be forced to back off a little bit. So I think there's something that's more sort of problematic with what Trump is doing for real estate that I think I see as a bigger problem. I do think that the Fed will give us a little bit of a tailwind, so that's good, but I'm not thinking it's a huge tailwind simply because Trump luckily does not have full control of the Fed. He can only influence them. So we'll get something out of it. I
Well,
think
what's even interesting? Go ahead.
yeah,
Sorry, Neal.
what I'm worried about is that if he kicks out another million or 2 million people, it will significantly bring down rental demand. Now, mostly it will not bring down single family demand as much on the multifamily side. Obviously, on the
Hmm.
multifamily side, when rents fall, it affects single family occupancy and single family rents. So I am worried about how many people these folks are going to kick out.
Yeah, I definitely think it seemed the indicators show that it's going to keep going, and that's like a very interesting perspective. I didn't really put it together until you just said that. As
Well,
far
let me give
as
you the
the
flip side of that, though, that there's good news.
Okay,
So the fact that a million immigrants may not need apartments anymore. And remember, it's not a million apartments, because on average, immigrants tend to really get crammed in apartments.
Yes.
So a million immigrants is like 200,000 units. So it's not as big of a number. Don't be as scared of it. But here's the other side of it. Did you know that between 25 and 34% of all the construction workers in the United States are undocumented? And they have not been showing up for work for the last 6 months. And so everything we're building, single family, multifamily, is now slowing down drastically and is much more expensive to build. So obviously, that's great news for people holding existing property. And it's inevitable that it will slow down single family and multifamily construction. So now we are seeing quotes go up a lot in 2026, but we didn't see that in the second half of 2025 because people are like, well, they'll come back. Well, they didn't come back, and now everyone basically has to pay more. So I guess it's good news for Americans because when an American that lives here takes over that job, they typically get paid more. So that's good. But it's really good for landlords, right? Because I mean, if we were already not building enough, especially on the single family side, maybe not on the multifamily side. But now we can't build more because the people are missing.
We're missing, yeah. And then the cost is going up. This kind of reminds me of so a good friend of mine. She moved from California, moved to Tennessee, bought acreage there. She's building. She built her barn first. The house is coming next, but she's been getting quotes. And she's in college. I think it's called College Grove or College Park. It's just south of Nashville, and north of Huntsville. She called me. She's like, Maureen, she goes, how much was it to get your pool, your underground pool built? And I was like, oh, about 80,000. It's not huge, but whatever. And so she's like, do you know what I'm getting quoted for a similar size pool in College Grove, Tennessee? I was like, no. She goes, $300,000 because they don't in Tennessee.
What the heck?
Because I know. I was like, we could just fly my crew in, right? And then just put them up. You still pay a lot less. But I think what you're saying is we're going to see more of.
Yeah, because again, a lot of these southern states, right? So Tennessee, Texas, Florida, Georgia had a lot of these people, right? Yeah. And they just abruptly stopped showing up for work. I don't know how many of them are still in the U.S., but they haven't been showing up for work. So we're going to see a spike in construction cost, labor cost across the board, across the U.S.
And a delay of those projects coming online, which then only exacerbates the supply shortage.
Exactly.
Oh my goodness. Well, God, I just would pick your brain forever. Is there any last, I guess, advice, good tidbits, something good and juicy for 2026? Like give us something good, Neal.
We've got to learn from Warren Buffett and Charlie Munger, right? So, Berkshire Hathaway has been the most successful company in the stock market for 50 years. And you know what the first thing these guys always said? In 50 years of being the greatest investors of all time, these two men could never time the market, never time the bottom. But you know what they did is they said, once we figure out things are cheap, we never obsess about buying the bottom. We do what is known as dollar cost averaging. So if we think that we are near the bottom, we buy, let's say we have $100, we buy $20 worth of shares, then we wait for it to drop, then 20 more, then 20 more, then 20 more, then 20 more. And sometimes what happens is it starts to go up and we keep buying. And so now what we have is a smile where we've got, 5 different purchases at different points on the curve, and we've timed the bottom. And they said, with all of their geniuses, Berkshire Hathaway has tens of thousands of employees, they never figured out the bottom. But I consistently see investors basically trying to say, is this the bottom? Is this the best time for me to buy?
Oh.
Well, if people who've done this for 50 years and are the greatest investors of all time couldn't figure it out, what are your chances of figuring it out? And remember, they were successful. Berkshire has been incredibly successful, massively successful, created hundreds of billions of profit without ever timing the bottom. I don't think that you have the capability to do so. From a data science perspective, I can tell you it's almost impossible to do so because there's too many factors. What you have to determine is this market inexpensive or cheap? Like multifamily right now is 25% down from 2022, right? I consider that cheap. Now, on the single family side, you don't have that benefit, but there are individual markets that may be cheap. And I'll tell you why. Like, for example, my 2 favorite markets in America are Idaho Falls and Northwest Arkansas, right? So Idaho Falls is incredible growth market. Idaho itself is a great growth market, but Idaho Falls is phenomenal. I love Northwest Arkansas because of all the stuff that Walmart's doing and all the stuff that the Waltons are doing, right? So the Waltons are the richest family in America. They're getting older, so they're dumping billions, tens of billions of dollars into charity. And they're basically building this incredible city with amazing museums and roads and all kinds of things. They're basically giving their money away. And anytime that happens, that market becomes astonishing.
Yep.
So those kinds of markets exist. I just named two. There are 1,016 cities in the U.S., 323 metros. So if you study, you will see many, and they may be close to you. Maybe you live in California. Well, the Inland Empire is really a great market, and which
Yep.
I feel like has a lot of room to run. Even if prices fall in other parts of California. So I think the key thing is this: use data, use research, but don't try to time the market, because no one else has succeeded but millions have failed.
I don't think I could put a bigger exclamation point on what you just said, because I get, and I'm sure you get the question too. I've got it for over the 19 years. Like, when's a good time to buy? Is now a good time to buy? Should I put it by yesterday? And I kind of was saying, it's like the best time to buy real estate is today. The better time was yesterday. Right. And
Well,
I
I'll
think
give
the
you a
only
tip
person
on that. If everyone says it's a great time to buy, it's probably not a great time to buy.
So that it goes back to what Warren Buffett said, which is, when everyone is greedy, be fearful. And when everyone's fearful, be greedy.
Yep.
So buy on the low end. Neal, you are just, I am almost speechless, but I'm just so grateful. Thank you so much. You contributed so much value to this episode, and I cannot wait to get the word out more about you. And you guys have to tune into him. If you've got anything of value out of this, which I know you have, definitely tune in to Neal Bawa and Toby. Is Mathis or Matthias? How does he think? It's
Toby
Mathis.
Mathis. Toby
Toby
Mathis.
Mathis.
Yeah. So
Yeah.
you can just type in Neal Toby into YouTube.
YouTube.
Now we do ourselves 8 webinars a year, and we cover all sorts of interesting topics. So obviously single family and multifamily, but we cover things like Airbnb, we cover AI, we cover climate change. And so we do these webinars, and tens of thousands of people sign up for them. And they are free, completely free. They're data driven, usually 50 or 60 slides. They're very beautiful slides. And you can check them out at multifamilyu.com/club. That's multifamilyU.com/club. And I can promise you it's always free. We have no tiers, we have no education products, no programs, there's no subscription. We believe education is like Wikipedia. You give it away, and then maybe 1% of those people will contribute. In our case, 1% of those people invest in our projects. The remaining 99 get it for free. So check it out at multifamilyU.com/club.
Yeah, you don't want to miss it, guys. I've listened to many of Neal's podcasts, webinars, and I always walk away a little bit richer in my confidence, in my knowledge. And then I get to share that with you guys, because guess what? I think Neal feels the same way, is that anytime I interact with somebody, brand new investor, they're just kind of thinking about investing in real estate. My whole goal is to, one, understand their why. If their why is big enough, it's compelling enough, they're going to go ahead and do it. And two, I want them to be a more confident, comfortable investor when they get off the phone with me. If I can give them a little nugget that's going to make them a little bit better, a little bit more knowledgeable, a little bit more skilled along their real estate path of progress, then I love that. And I know that is Neal to a T. Any last words, Neal?
No, I just want to thank you all for having me on the podcast, and hopefully we get to do this again in a year.
We would love it. Thank you so much. You are my special guest. I am a huge fan. Everyone, check him out, look him up, Neal Bawa. And with that, this is Spartan on the House. Maureen McCann signing off. We'll see you next episode.